Hey, welcome to the Market of the Moment update for the week of June 20th. Michael Oldham here with Chris Madrid, Guaranteed Rate. What's up,
Hey,
Chris?
what is happening?
Not much week. Let's start with mortgage rates. What are they looking like today and how have they been trending over the last week?
Man, it has been a wild ride in the mortgage lending world. This past, oh my gosh, what's today? Yeah, last week, the Fed met, right? So the Fed came out and we saw the big 75 basis point rate hike, which to the market basically said that the Fed is now taking inflation seriously, right? Which they probably weren't before, but because we got 75 basis point rate hike, the Fed is now taking it seriously. Powell, I think in some of his comments came out and said, yes, we are definitely headed for a recession. But I mean, man, at the end of the day, I think historically when we hear recession, we think of like the Great Depression, we think about the Great Recession of 2008. And really all the recession is it's two back-to-back quarters of negative GDP, right? That's really it. So it's not like this big negative thing. Now, obviously, negative GDP is not good for the overall economy. But as we've seen with inflation getting out of control, it's just one of those things that needed to be pulled back a little bit. And from a tool perspective, raising the federal funds rate is really the only tool that the Fed has to try to pull back inflation. So thankfully enough, rates have they have topped off, right? So we've started to see them, and we saw rates last week get up to about 6.5% on the 30-year fixed, and they've now started to come down a little bit. So we're seeing still, we're down to probably 5.6, 5.7, up to about 6% on like a conventional 30-year fixed. FHA rates are down in the probably 5 to 5.5% range. Adjustable options, we've started to hear a lot more about ARM products, right? And back in the day, there was an adjustable option that was called a pay option ARM, and that would give people the opportunity to pay less than the interest due on the mortgage. So when a lot of the times when people hear ARMs, that's all they think about, right? They think about the negative amortization, and that's not what these products are, right? So the negative am, those are essentially gone, right? No one's doing those anymore. There are still lenders doing interest only, and then ultimately, like these products, the ones that we offer on traditional financing, traditional homes, are you have a lower fixed rate for a 5, 7, or 10-year year period, and then after that point in time, it can adjust. But the reason that these are becoming more attractive is we're seeing these ARM products in the low fives, right? So 5 to 5.25 range. So if you lock in a rate for the next 5, 7, 10 years in the 5% range, and we know that most likely interest rates are going to be coming down in the next 1 to 2 years, right? This is a great opportunity to take advantage of the lower rate on an adjustable product, and then you're refinancing out of it to a fixed rate product in the next year or two. So again, it's having the conversations, making sure you're aware of the options and opportunities that are out there, and then at the end of the day, being able to make the best decision. In the short term, it feels like interest rates are improving, but if inflation doesn't get under control, which, man, it's at this point, it's kind of hard to say. I still think overall the trends, right? Interest rates are still an upward trend. So we've seen a little bit of a reprieve here over the last week or so, but I think overall between now and the end of the year, interest rates may still continue to creep up a little bit. And again, like I think it's man probably in a prior video we talked about, there is going to be the the kind of ups and downs as we still move upward, right? And it's taking advantage of those opportunities when they come. So we've had a lot of calls, regarding getting interest rates locked in and all that good stuff. So yes, the biggest thing is making sure whoever you're working with, they follow the market, they know what's going on. You can capitalize when rates dip a little bit, right? So those are the big components.
All right. Well, so we talked about recession. Obviously, there's a definition for it, and what's happened over the last couple of months, fits the definition for recession. But like Chris said, often when we hear the word recession, we think of depressions, and basically it's just a slowdown in productivity. For one reason or another. It could have to do with supply chain has caused probably the fuel cost. All of these things contribute to slowdowns. So, but let's talk about what housing does during a recession. You've got a couple charts here. So,
these are so again, we've been saying this for the last gosh, I don't know how long, that what normally happens when inflation obviously gets out of control like it is now. We've talked about how the Fed will raise the federal funds rate, and then traditionally what ends up happening, and we can kind of see it here in the charts, is then mortgage rates start to move down. So so in the 80s, right, when mortgage rates got up to 18%, we can see there in the second wider yellow block there that obviously mortgage rates peaked 18%. The Fed started to drop the federal funds rate, and essentially mortgage rates went from 18% to 13%. And even before that, right, there's that little blurb in the earlier 80s where mortgage rates were at 16%. After the Fed had moved the federal funds rate up, right, and then we see that sharp decline, and of course right after that mortgage rates went from 16% down to 11.75. And there's again, we can kind of keep seeing these trends. Back in the 90s, mortgage rates were at 11, federal funds rate had moved to its highest point at that time, and then immediately the Fed pulled back on the federal funds rate, and mortgage rates went from 11 down to 8.75. We saw it again in the early 2000s, right? The federal funds rate had peaked and it moved down. Rates went from 7.3 down to 6.7. We saw it back in the early, in the 2008 to 2010. That obviously was a little bit different, right? We know that there was a huge oversupply in housing, so there was essentially a housing bubble then. Not to get confused to what we're seeing now, where there's just essentially an undersupply of housing. But clearly then rates peaked at 6%. The federal funds rate came down and mortgage rates dropped down to 4.8, right? So this is the data that we've been talking about, right? This is where a lot of this information comes from, is if we look back through history and through some of the things that have happened before, it's kind of a telltale sign of what's also on the horizon. So any questions, comments?
No, just you just noticed the trend from the 80s. The trend, even though it's ticking up and down, the trend keeps going down, down, down. So we have a long ways to go based where we're at, ticking to tick up. I would say, like, once it gets to that 6% again, my gut would tell me it starts ticking back down a little bit. So, but anyway, you're the expert on this one. Let's look at this chart here.
It was that was another one that that we found, or that we'd found earlier, and just talking about, again, the dark blue lines are recession, and then of course the line is the national price index, right? So we're clearly seeing, again, from when they started tracking this back in the 60s, we see the recessionary periods that are clearly defined there, and essentially housing back in 0809, when it dipped, that was due to an oversupply. It was also due to the pay option arms, 100% financing on on loans below 600 credit scores. I mean, there's just numerous things that obviously contributed to that downward trend, right? So not to be obviously taken out of context. We know why that happened there from a housing perspective. But since then, right, I mean, it's continued to move upward post recession. So I think that's the key there.
Yeah, and when I look at this chart and I see one spot on it where it took a massive dive, and that was during the 05, 06, 07, 08 timeframe when we had an oversupply of houses. It took until 2010, 11 to buy up all those houses, and then since then, I would think builders kind of started capping what they were doing.
Oh, for sure.
2011. But gosh, then you just look at that house appreciation is basically what this is. It just goes through the roof from 2011 to our current time frame. And the last 2 years, you can see, like we've been talking the last several weeks about our appreciation here in DFW area. This is national, of course, but you can see nationally the last 2 years, it's just exploded. I assume the last dark line is COVID, the pandemic.
Yeah.
And so
there was a recession in 2020.
So we didn't even know about.
Well, it definitely wasn't publicized, but it was definitely there.
So we hit those 2 months. Hit the definition. So
one other thing, I know we're transitioning to a little bit different topics. One of the other things that I want to just really touch on is again, man, we're getting a ton of questions of like, hey, should I buy now? Should I wait? Look, again, I'm kind of just taking a 5-year block, right? So if we look at the next 3 to 5 years versus now, right? We know that inventory is still super low. Yes, interest rates have moved up, for the time being, but man, I feel like something that we haven't seen before that we're seeing a lot of now is essentially corporations purchasing a majority of the housing that's out there, right? And that, we saw, and I read a stat yesterday, and I can't remember off the top, but more and more, of these big corporations are purchasing up, gobbling up, whatever you want to call it, a majority of the houses out there, and then are turning around and leasing, right? So from a perspective standpoint, like if we think it's difficult now to purchase a home, or to rent or whatever it is, imagine when a majority of the housing has been gobbled up by these big corporations, and how difficult it's going to be in the next 3 to 5 years, right? So again, like opportunity, I feel like right now is knocking, right? There's been a lot of buyers that have kind of fallen off the housing purchase wagon. But if you have the ability, I mean, right now is really the best time. Yes, interest rates are slightly higher. I heard a comment or read a comment the other day. It says, or marry the house, date the rate. Right. It's kind of it's a whatever, one of those trending things. And it is so true. Like, again, don't get caught up in the fact that mortgage rates are at 6%, right? You find the home that you love, that you're going to live in for a while. We already know historically, like we've shown you today, interest rates are going to come back down, right? So marry the home, that's long term. Date the rate. We know that again, there is an opportunity to be able to refinance to a lower rate down the road.
Yep, you can break up with the rate when a better one comes along.
100%.